Your agency might be sellable, but your financials could kill the deal. A PR agency just got acquired. Big headline, big win. But here's the question nobody's asking. Would your agency survive buyer diligence or fall apart under it? I'm Craig Cody. I'm a CPA. I work with marketing and PR agency owners doing between $1 million and $10 million in agency gross income. And today I'm going to show you why a lot of agencies look sellable, but their financials tell a completely different story. Buyers don't buy revenue, they buy the financial story. Here's the mistake I see all the time. Agency owners think, my revenue is strong, I'll get a great multiple, but that's not how buyers think. Buyers are looking at margin consistency, predictability, risk, and quality of earnings, because they're not buying your creative, they're buying your ability to produce profit without you. And this is where things break down. Revenue looks great, but margins swing month to month. That's a red flag. It tells the buyer the business is not controlled. Busy teams don't mean profitable agencies. Your team is slammed, everyone's working, clients are happy. But when I ask, what's your utilization rate? What's your margin by client? I get silence. That's a problem because agencies don't fail from lack of work. They fail from unprofitable work. You need to know which clients actually make you money, which ones drain your team, and where your gross margin really sits. Without that, you're guessing, and buyers don't pay premium multiples for guesswork. Messy financials kill deals fast. Now let's talk about what really shows up in diligence. This is where deals fall apart. I see financials packed with one-time expenses mixed into operations, personal expenses buried as add-backs but very vaguely explained, owner's compensation all over the place, and no clear separation between recurring and project revenue. From your perspective, it all nets out. From a buyer's perspective, it's unreliable. They start questioning everything, and when trust drops, valuation drops, or worse, the deal dies. Quick question, do you actually know your most profitable client right now? Not your biggest, your most profitable. Drop it in the comments if you know it. Owner dependency is the silent killer. Here's the one nobody wants to talk about, the owner. If you close every deal, manage key relationships, and are tied to delivery, then the buyer isn't buying a business, they're buying a job. And that's not scalable. It's not financeable, and it's definitely not worth a premium multiple. What an exit-ready agency actually looks like. If you want to fix this, here's where I'd start. Clean, accurate, monthly financials, gross margin tracked by client, owner compensation normalized, add-backs clearly documented, recurring versus project revenue separated, client concentration tracked, and tax strategy done before the deal, not after. This is what creates quality of earnings, and that's what drives valuation. Let's simplify this. Before you talk about selling your agency, you need to ask, are my numbers clean? Are my margins consistent? Can this business run without me? Because a clean agency is easier to run, easier to finance, easier to sell, and honestly, easier to sleep at night. If you're an agency owner and you're thinking about selling in the next 1 to 3 years, you should not wait. The best time to prepare for a buyer is 12 to 24 months before they show up. If you want to know what your agency actually looks like through a buyer's eyes, go to the link below and book a call. We'll walk through your numbers, identify the gaps, and then show you exactly how to increase profitability, cash flow, and position your agency for real exit.